Tried getting a small business loan recently and just hit a wall? Yeah, that's not bad luck, that's a broken system. And the government just tried to fix it. Here's what's been going on: India's microfinance sector. These are the lenders that specialize in small loans for vendors, freelancers, self-employed folks, has been stuck in a serious liquidity crunch. Basically, they ran out of fresh money to lend out, and the fallout from that? An estimated 50 lakh customers got locked out of formal credit entirely. 50 lakh small hustlers just shut out. So on March 20th, 2026, the government launched what's called the Credit Guarantee Scheme for Microfinance Institutions 2.0. CGS MFI. 2.0 if you enjoy acronyms. Think of it as an insurance policy for banks. See, banks were nervous about lending to MFIs because if an MFI defaults, the bank eats the entire loss. Under this scheme, the government steps in and says, we'll cover 70 to 80% of that loss. Suddenly, banks aren't so scared anymore. The total safety net backing all of this? 20,000 crore rupees. That's a serious injection of confidence into a sector that was basically gasping for air. The scheme runs until June 30th, 2026, or until that 20,000 crore rupees guarantee cover is fully used up, whichever hits first. So the clock is already running, and here's the key thing to understand. This doesn't put money directly in your pocket. What it does is unblock the pipeline. MFIs can borrow from banks again and then lend to you. The government quietly oiling the gears so the whole credit machine starts moving again. But, okay, knowing the scheme exists is one thing. The real question is, does it actually work the way it's supposed to? Who benefits and who might still get left behind? That's exactly what we're getting into next. Now let's get into the part that actually matters. Who wins? Who loses? And what this does to your wallet. Actually, if you borrow from a small or mid-sized MFI, think your local or regional lender, not the giant national ones. This scheme is basically a gift. The smallest MFIs, those managing under 500 crore rupees in loans, get an 80% guarantee cover. Mid-sized ones, up to 2,000 crore rupees in AUM, get 75%. And on top of that, 15% of the entire 20,000 crore rupees fund is reserved exclusively for them, like a priority queue at a sold-out concert. So your neighborhood MFI is now far more likely to unlock fresh bank funding and actually pass it on to you. Now here is where it gets interesting for borrowers. Interest rates under this scheme are capped. MFIs borrowing from banks can only be charged up to the benchmark lending rate plus 2%. In plain English, banks cannot overcharge MFIs, which means MFIs are far less likely to overcharge you. We are talking rates at least 1% lower than before. On a 2 lakh rupees business loan, that is 2,000 rupees back in your pocket every single year. And there is a built-in 1-year moratorium, a pause on repayments, which can translate into more breathing room for your cash flow when you need it most. But not everyone comes out smiling. Large MFIs, the ones managing over 2,000 crore rupees, get the lowest guarantee cover at 70% and are capped at borrowing just 300 crore rupees each under the scheme. Their growth runway just got shorter. And informal moneylenders, they're suddenly competing against cheaper, formal credit, which honestly is the best news in this entire story for anyone who has ever been trapped in a high-interest informal loan. So the structure is clear. But how does this actually flow from government policy all the way to a borrower in a small town? That is exactly what we are breaking down next. So yes, the scheme is genuinely useful. But here's where it gets real. Because every limited time offer has fine print, and this one's no different. The biggest catch sitting right at the top. This scheme expires on June 30th, 2026. That's roughly 3 months from launch. And it could close even earlier if the full 20,000 crore rupees in guarantee cover gets used up before that date. So the clock is already running. This is not a permanent fix. It's a short-term liquidity bridge, designed to stabilize MFIs after a rough patch, not rebuild the entire sector from the ground up. Once it closes, MFIs are on their own again. And if the underlying stress in microfinance hasn't actually healed by then, another crunch is absolutely on the table. Now, the second thing worth keeping in mind, and this is important, no structural reform of the MFI sector is guaranteed after the scheme wraps up. The benefits are temporary. Policy goodwill isn't the same as permanent infrastructure. So what does all of this mean for you specifically? If you're a micro-entrepreneur, a freelancer, someone running a small business on working capital loans, your window to access easier credit and more favorable rates is narrow. Don't sit on it. Go to your MFI right now and ask them directly. Are they participating in CGS MFI 2.0? Are they actually passing on the lower interest rates? What are the repayment terms? Because the infrastructure is unblocked right now, 50 lakh borrowers are being pulled back into the formal credit system, and rates are better than they've been a while. Treat this exactly like a limited time offer on formal credit, because that's precisely what it is. The window may not stay open long. Act before June 30th, 2026. And that's the full picture on this one. The what, the why, and the you should probably move on this. Stay tuned for more breakdowns just like this. Follow us for more updates like this. Thanks for watching. And don't forget to follow us on YouTube, Instagram, and X.